Interested in gaining exposure to crude oil prices? For many investors, that's not always a simple task. Physical investment needs operational know-how and expensive infrastructure, and using derivatives can be complex. A simple alternative is investing in oil exchange-traded products, or oil ETPs. Let's look at the crude oil market and see how ETPs fit in. There are many different grades of crude, but two oil-grade benchmarks dominate the global market: Brent crude and West Texas Intermediate. ETPs work by tracking total return indices underpinned by oil futures, typically based on the two major benchmarks. An oil futures contract is an agreement to buy a specified amount of oil on a future date at a set price. Contracts vary in duration, with maturities ranging from 1 month to 3 years or more. At expiry, the contract can be settled physically by delivery of the underlying oil barrels, or financially, based on the value of the contract at expiry. For any given maturity, futures prices are a function of the spot price, prevailing interest rates, and oil storage costs. An ETP's price reflects what's known as a total return exposure to the underlying oil futures investment after fees and costs are deducted. This total return has 3 components. The price return reflects price movements in the underlying futures contract. The roll yield is the loss or gain caused by reinvesting or rolling a futures contract that's nearing expiry to a longer dated one. Rolling is necessary for an oil ETP to maintain constant exposure to oil prices. It's important to recognize the roll yield can be negative or positive. For an investor who is long, the oil price rolling into a longer-dated futures contract that's priced higher, known as contango, the investor incurs a loss. And if the new contract's priced lower, known as backwardation, the investor enjoys a gain. And the collateral yield is the interest earned on the cash value of the investment. That's why the returns from ETPs can be different from those quoted by mainstream sources. An additional factor is currency exposure. Because crude oil is priced in US dollars, so too are oil ETPs. That means non-dollar investors inevitably take on a currency risk. To mitigate this, investors can buy currency-hedged oil ETPs. Oil ETPs can be traded directly through online trading platforms and brokers, or through financial advisors. They provide a simple, cost-effective way to acquire a total return investment in oil futures whilst avoiding the complexity of futures trading. If that sounds interesting, visit WisdomTree's website and find out more.